Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
So let's also get to what? Our most read story on the Bloomberg.
Yeah, it's about how Eli Lilly is now selling vials of its blockbuster weight loss drug Zepbound to patients for as little as $399 a month. This as it works to overcome supply shortages of its wildly popular shots. Here to explain on the GLP-1 beat is Bloomberg News health reporter Madison Muller. She's here in our studio. What's going on here? Because this is a different delivery mechanism, at least initially.
Feels do-it-yourself.
A little too DIY for my liking. Let's just say that. Patients are going to be required to fill up their shots themselves with these vials?
Yeah, so patients take a syringe, put it into the vial, and you sort of draw up the liquid into the vial, which a lot of people, though, are used to now because of the popularity of these knockoff drugs that we've talked about before. Those are all the single-use vials or the multi-use vials, and so patients are really used to that now.
So why, does Lilly have to do this, or why are they doing it? What's strategy here?
So this is, and I think we've probably talked about this on the show at some point too, the fact that Lilly's production problems are really stemming from the pens, the auto-injector devices that are used are really complex to manufacture, and so that's been bottlenecking supply. So by offering their weight loss drugs in vials, they can circumvent those issues with the making of the pens.
What about the direct consumer angle here? Because I don't think I've ever been able to get a prescription directly from a manufacturer. There's always a middle person as a pharmacy, whether it's an online pharmacy or the old-fashioned kind of pharmacy that you go to. Is this a new way for patients to actually get a medication from a producer?
Yeah, it's interesting because Lilly Direct, which they launched earlier this year, it's still partnered with various telehealth companies and online pharmacies that, like Amazon Pharmacy, for example, that will just send the medications directly to your house. So Lilly isn't the one, like it's not Eli Lilly doctors that are writing the prescriptions. It's not an independent Eli Lilly pharmacy, but they've built up this platform that directs patients to their website. They said that can help, with savings in terms of applying savings coupons and things like that. And then when it comes to these vials, they have it's cash pay only, so patients are not able to use insurance with these vials, and it also goes through Lilly Direct.
What is demand for this drug outside of insurance?
People are really paying for this drug.
So up to $1,000 a month if you don't have insurance,
exactly.
But these are $400 a month.
Right. Is a pharmacy on the east side or the upper west side lately?
No.
Yeah,
why? What do you see?
I'm just saying.
Yeah.
It's a pretty popular drug of people who just want to lose weight.
Right. Huh. And all these compounding drugs that have gotten so popular that we've mentioned, those are all cash pay. You can't use insurance for those drugs. So that market's really been growing.
You bring up an interesting point, though, which is, a little bit niche because it's so expensive. We're talking Manhattan here.
Correct. Absolutely.
And it's not necessarily, what the drug was developed for, Madison, as you've spoken to us at length over the past couple of years about this. But are there folks out there who are not getting this covered by insurance, a significant number of them, and they're having to pay cash?
Yeah, the insurance coverage is still quite spotty across the U.S. And for people who do figure out, okay, this is worth it for me, I need this for my health, they make those decisions. But it's still really hard to get this covered, and that was one of the reasons why Lilly is launching these vials, especially, they said, for Medicare patients, because Medicare does not cover weight loss drugs at all. And so they said, and Medicare patients also can't access savings coupons that Lilly offers. So they were like, having these vials options is something for Medicare patients that is at least a little more accessible.
It sounds like to me too, Madison, that it's something that's going to help Eli Lilly's bottom line, which has gotten messed up because of the problems with the production of the injector pens. But at the same time, it does sound like it still expensive, but does make it a little bit more accessible to folks.
Yes, it definitely makes it more accessible. And from a couple of the patients that I talked to this morning, they were really excited about this.
Yeah.
One of the patients that I've interviewed before who kind of started this whole campaign earlier this year called Release the Vials to get Lilly to do this, he was so excited about it. And he was like, I really thought that they never would actually do this, or at least they would launch the vials and they would still be exorbitantly expensive. And so he was like, to me, this comes off as a good thing. The thing is, though, just reading through some of the analyst notes and in conversations today after this news came out, for Lilly, it doesn't really affect the net prices in the long term, even though it seems like a discount. But they've also raised the price of one of their savings coupons, so that kind of offsets each other. And in terms of like the revenues that Lilly is collecting from Zepbound, doing this doesn't actually have a negative impact on their bottom line.
Doesn't have a negative.
Doesn't, yeah.
Yeah.
Okay, we've been talking about the popularity of the GLP-1 class of weight loss drugs. Do you have any sort of third-party data, or is there any sort of estimate out there that actually pinpoints the percentage of Americans, the number of Americans who are taking one of these drugs right now?
I mean, we know it's in the millions. It's been a little bit hard. There's been some estimates. I think it was like 3 million or 4 million a couple of months ago was the most recent that I saw. And it's, I mean, I can imagine only gone up since then. And then you add in all of the people that are taking these knockoff drugs, and there's no way to really track that. So that's a whole other portion of the population that we don't really know how many people exactly are on those, but we know just from sort of piecing it together ourselves that it's likely hundreds of thousands.
You know, we had another story that's out on the Bloomberg about Pfizer following Lilly with a site selling directly to patients. Are we going to increasingly see this?
It seems like that's what I'm hearing from people in the industry, that this is a trend that after Lilly launched Lilly Direct last year, more and more pharmaceutical companies were like, this is an interesting option, and this is something, it doesn't work for all drugs, obviously, but for something like migraine drugs, which Pfizer has and which is going to be part of their direct-to-consumer platform, it makes sense for patients who are already sort of Googling, you know, is migraine drugs right for me? And then they can go to Pfizer's website and learn about it and sort of like be connected to doctors there.
Not so great for the pharmacy benefit managers and the large traditional pharmacies.
Yeah, I mean, it doesn't cut them out entirely. Like, the middlemen still exist. And like I said, Lilly is partnered with, and Pfizer as well, partnered with these third-party pharmacies and telehealth companies. So it's not cutting them out entirely. It's circumventing them and not really going through these traditional channels. So it's like, it is interesting, and we don't know yet how this will change the traditional model.
It's like poking at the model a little bit.
Yeah.
We'll see where it goes. Thank you so much.
Thank you.
Always. Madison Muller. She's health reporter at Bloomberg News. Check her out, too, on Twitter at Going Mad.
You should have read that
She's
a couple times.
Exactly.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Hey, folks, we got a fresh read on the U.S. consumer this morning. U.S. consumer confidence rose to a 6-month high in the month of August as more upbeat views of the economy and inflation, Tim, offset waning optimism about the U.S. labor market.
Yeah, measure of expectations for the next 6 months rose to a one-year high of 82.5. That was in August. A gauge of present conditions actually edged up. For another take on the U.S. consumer, we welcome back with us Silvio Tavares, CEO of VantageScore. It's a joint venture of Experian, Equifax, and TransUnion. What they do is they provide credit data, credit risk modeling, and analytics. He joins us from San Francisco. Silvio, how are you?
Great to see you, Tim. Great to see you, Carol.
Hi.
Great to be on again.
Hey, how would you describe the consumer right now?
Well, the consumer has become cautious, and that's a market change in the most recent insights that we have for VantageScore credit gauge that we published this morning. The reality is delinquencies are up significantly, and also credit utilization is down. So consumers, if you look at the percentage of their available credit lines that they're using, that's at a 4-year low, dropped to 51.6% for the most recent period. And then if you look at it from the perspective of banks, banks have also become cautious. They reduced their new credit accounts in the most recent period of July across every single credit category: auto loans, personal loans, credit cards. And so the reality is that sets the stage for a Fed rate cut, because exactly what the Fed wanted to happen, a cooling in the economy, we see that perfectly crystal clear in the latest insights that we have.
Is this all manageable, or does it send to you some warning signs about the consumer really heading into some trouble?
Well, for sure, these are warning signs, particularly what we saw in July, which is really right across the board. If you look at credit utilization, that's at a 4-year low. The spike that we saw in late payments, what we call credit delinquencies, the spike June to July in credit delinquencies was the largest we've seen in 4 years. So the consumer is flashing some warning signs heading into September. And that's exactly why the Fed, as recently as yesterday and on Friday in Chairman Powell's speech, they're signaling they're gonna cut rates. And when we look back on this, what we're gonna say is this was the right time to do it.
So do you think that we'll see, or you in your world will see, an immediate reaction as a result of lower rates when it comes to the metrics that you look at, Silvio?
Yes, immediate is, depending on the time horizon you look at, but for sure there will be an impact this year. The challenge that the Fed has is not whether to decide whether to cut rates or not. They pretty much said they're going to cut in September. The question now is how much. If it's too much, they risk reigniting inflation. If it's too little, then of course that potentially means the economy will decelerate further, and the economy could slide into recession. And so it's a real challenge to get that exactly right, particularly in the context where consumers actually right now are cautious, but as they look out over the next 6 to 12 months, consumer confidence is quite high. We saw that in the data. Also, consumer credit health overall is actually still pretty good. The average VantageScore credit score, 300 is low, 850 is high. Through the end of July, it was 702. So consumers are actually credit healthy, and they have the ability to take on more debt. So I think it's going to come out that the Fed is probably going to cut by a 1/4 point, and then see what happens, and then wait till later on in the year to see if they need to do more.
Two things. I am curious because it sounds like a mixed bag of data that I'm hearing from you, or mixed tones in terms of, credit utilization, as you said, fell to a new 4-year low, credit delinquency spiking in July, highest month over month, jump in more than 4 years. Couple things. So is there a net takeaway about what it says about the consumer? Because it sounded like earlier you said that there are some worries and some concerns here, warning signs, I think you said in July. But I feel like there's also some things that aren't so bad. So I'm not quite sure what the takeaway is. And who are these consumers? This latest survey, that you guys do, the credit gauge data, is it a cross-section of consumers? Can you give me some idea in terms of the demographics of who actually are in these surveys?
Right. And so these are not surveys. These are actual consumers' credit score, and it's across all Americans that have a credit report. So it's the most comprehensive data set that we have about credit health. So Tim,
me, everybody in my control room, we're all in there.
You're all in there. We're all in there. And in fact, we score approximately 30 million more Americans than our next competitor. And so the signs, and this is what changed in July, the signs for the first time are actually consistent across the board. Credit utilization and the low number there shows that consumers are cautious, and they think taking on additional loans is too expensive right now. So that shows the economy is slowing. When you look at delinquencies increasing, the most we've seen in 4 years, that's another sign that the consumer is cautious but actually hurting. It's a sign that the employment picture is deteriorating. And third data point, when you see banks reducing their lending, banks are obviously in the business of lending. When they reduce that, that means that banks are also cautious and concerned about the risk ahead. So all three warning signs shows very clearly the economy is slowing down, consumers are ratcheting back, and that's exactly what the Fed intended. That's why they kept rates as high as they did. And now it's time to take the foot off the brake and let the economy grow again. And that's what we're going to be doing in September.
Hey, Silvio, we are all eyes on AI because of NVIDIA earnings tomorrow after the bell. I'm wondering how...
on AI, is that what you said?
AI.
Nicely
right.
done.
Thank you.
You're welcome.
How are you using AI at VantageScore when it comes to consumer credit and determining credit scores?
Yeah, and so this is one of the areas that, there's been not sufficient focus on. The reality is VantageScore and credit scores are inherently an AI product. We use advanced machine learning to look at a consumer's credit report over time. We call that trended data. And we have an algorithm that spits out a 3-digit number. If it's low, you're not very credit worthy. If it's high, VantageScore 850, you are very credit worthy. And so it is the use of AI. But we do one thing which is very, very important. We always look at our algorithms and make sure that they are producing fair and equitable outcomes. And to do that, we include all of the best data. So we were, in fact, the first credit score to include rental data. Believe it or not, before us, nobody used rental data in the credit score calculation. We're also recently the newest score to actually use open bank account data, open banking data. We're the first to use that. And that enables us to have a really good read on how consumers are going to pay back their loans, and also including the maximum number of consumers to pay have a credit score.
I do worry, though, if consumers are feeling a little squeezed and a little warning sign that if the Fed lowers rates, do people kind of start to ease up again and spend again because rates go down? I just wonder if that potentially creates some consumer problems going forward, which means we will have to check in with you again, Silvio. Good to check in. This time, Silvio Tavares, he's Chief Executive Officer of VantageScore, joining us from San Francisco.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, so in the last hour, we really just mentioned the Kelsey brothers signing a big multi-million-dollar podcast deal with Amazon. There's a lot going on in the sports issue, including, if you check out the new issue of Bloomberg Businessweek. Shameless plug, but there we go.
Okay. It's pretty awesome. It's a takeover, I think it's fair to say.
It's definitely a takeover, and it really gets into the new age of sports betting, where it feels like it was like many years in coming, it feels like, and then it just took off in a big way.
Yeah, it's come on big time, where the state tax revenues are going, how it affects the play and sports media, some of the big players, FanDuel, DraftKings, versus a tiny little company. Called ESPN.
Yes, indeed.
All that and more. It is a no-holds-barred look at how betting has devoured sports, which will be featured in the forthcoming issue of Businessweek Magazine. Check out all the stories now on the Bloomberg terminal and at Bloomberg.com/Businessweek.
All right. Overseeing it all, Bloomberg Businessweek Senior Editor Bret. He's joining us in our Bloomberg Interactive Broker studio. Congratulations. Cool stuff as we all get ready for the U.S. Open. There's a lot going on, certainly in the New York Metro. Go back, though, how this deep dive came about and how you and the team thought about what you wanted to cover. I'm assuming sports came up generally, and then did you guys kind of settle on this? How did it come about?
Yeah, this little thing called the upcoming NFL season.
Oh yeah, that too.
Small little thing that some people are interested in. It came about because for anyone who watches sports like myself, you now can't really watch sports without being completely inundated with ads for, as you mentioned, DraftKings, FanDuel, ESPN Bet, Bet360. I mean, we can go on and on, but essentially every other commercial now is related to a sports betting app. And we thought, let's take a look at this.
You guys have the numbers, too, to back this up. It's not just that you're, noticing more ads for this. I was pretty shocked to see this, Carol. Last year, Americans spent almost $120 billion on legal sports bets. It's a 28% increase from just a couple of years ago.
Yeah, that's a big bump.
Huge bump. I mean, that's basically, we can trace this back to 2018. So 2018, the Supreme Court said that there can be sports betting outside of the state of Nevada. We now have 38 states that have legalized it, plus Puerto Rico and the District of Columbia. So chances are you might live in a state where this is allowed, except it is not allowed in California, actually, at this point. But yeah, so it's become much easier for people to do this, as opposed to having to go to a casino, fly on a plane, go to a casino and do it. Now you pick up your phone.
I feel like there's a lot of different ways we can go, but I am curious about what the impact is on the states and the revenue that comes into them. And I'm also curious about what impact we're seeing on society. Before we dig a little bit deeper into some of the stories you covered, like, are we finding out that, yay, it's all great, or it's a little bit of a mixed bag?
It kind of depends on, it sort of depends on who you ask. I mean, the states wanted to legalize this because of the tax revenue that it brings in. What we found is that, a fairly small percentage of it is going to where you might want it to go, which is to help people who have problematic gambling patterns, right? A very small percentage of it goes there. A lot of it goes into state general funds, things of that nature. And in some instances, it goes to some odd things like aquaculture, or helping in very specific programs like helping to fight cancer in Michigan, things like that.
Okay. But it provides some extra revenue.
It does. It is extra revenue that's coming in. This is why the states wanted to legalize it. It's not always going in exactly where you might think it's going.
What about what it's done to the financial health of the folks in the states where it's legal?
Yeah, I mean, in terms of the states where it's legal, there was a recent report actually pointing out that this has led to delinquencies on credit, bad debt, all the things that you can imagine happening when you
Not good.
when you have access to spending all this money on your phone. Yeah.
Yeah, not so good. All right, so tell us about, we'll get ready for some studies in the future that will probably about the impact on society as a result. What?
Yeah, well, I don't know where you want to go. There's so many places we can go.
Well, so go through like some of the different stories and how you guys wanted to approach it.
Yeah. So one thing we wanted to do is definitely get the players' perspective in
Yeah.
here. So we talked to some current NFL players and some former NFL players.
And they love it?
Well, it's interesting. I wasn't entirely sure what to expect, but in many ways they're split. They say on the one hand it's great for the league, and it is great for the league, right? The league has partnerships with these apps. There's revenue sharing with the players involved in that. It's good for them. It keeps you engaged in the game longer. You could have a total blowout in the fourth quarter, but if your particular bet is riding on something that hasn't quite happened yet or been determined, you're going to still have eyeballs on the game. Eyeballs on the game means ad revenue, and that's good for the league.
Yeah, and one of the stories I remember reading that's in this issue, if a fan makes a prop bet, they're 20 times more likely to watch a sporting event. It's not just a prop bet, any bet. That's wild.
Yeah. I get it, though,
for
right?
engagement, it's huge.
It is.
Yeah, because you're screaming. How many times how many changeovers are there going to be?
How many times will we see Taylor Swift? No, just kidding.
That's a real prop bet.
I know.
It's the greatest engagement tool that there is.
Okay, so let's talk a little bit about integrity here, because that's a big question that I know a lot of folks have, and that was a really interesting story by Devin Gordon in the issue. How are companies making sure that pro sports players are not involved in these prop bets?
Yeah, so one of the requirements is that they hire what's called a third-party monitor, and we have a story, as you mentioned, by Devin Gordon, about a company called US Integrity. That's one of the biggest ones. Essentially, they partner with the leagues to essentially have eyes on everything. They're always watching at all times. And they're keeping an eye out for anything during a game that might seem suspicious. And I learned so much about what can seem suspicious where you wouldn't think just with the, the untrained eye. But you could have a point guard, crossing center court who's sort of dribbling a lot without moving toward the basket. And they can look at that and say, well, is this guy trying to limit the amount of points that his team is scoring in order to hit the under on an over-under? U.S. Integrity essentially sends out signals to the leagues like, hey, something might be amiss.
Doesn't it feel like AI is the perfect sort of tool to do something like this?
It does, and yet it does require like a tremendous amount of touch to it as well that maybe that hasn't come to AI at this point. Like in the Jonte Porter case, which we look at, yes, conceivably AI could have spotted the
because there was this
pattern.
weird correlation about these bets that were taking place on a separate platform.
Well, if you were to go make a bet today, you probably would put your money on somebody like LeBron James, right? That's who people bet on.
Yeah, even
Luka
I've heard of
Doncic.
him, and I'm not a big
right. You have heard of
basketball
LeBron
Kind of a sure
James.
thing.
Yeah.
I'm sure, right? But to be placing a bet on a role player is that will immediately sound get a red flag that goes up. So that's what happened in that case, and they looked at it once in January and said, this is strange that all of the unders hit on all of the potential bets you could make on him. Let's keep an eye on this. And then again in March, when he did the same thing, then they said, okay, something is quite fishy here. They notified the NBA. The NBA did an investigation. They ultimately suspended him for life.
But, in order to spot that there's something maybe awry, if you will, is, I'm assuming, a sharing of data from either the odds makers and so on and so forth, who I'm sure don't want to share their information, right? So in order for this system to stay pure and have integrity, right, like people have to be able to make sure that they're seeing everything that's going on.
Right, and the odds makers are in this position where they basically have to turn over all of their information to a company like
Not
US
a problem, right?
Integrity. Yeah, and we quote one who's like, oh yeah, so who do I have to turn this over to? Oh, there's only one company that I have to. Great, okay, so it is a bit of a I wouldn't call it a monopoly, but yes, they're not like thrilled about it, but they also realize that they kind of have to do it, and ultimately it does help them. They want a window into this as well.
Yeah, exactly. I mean, I do wonder, is someone, or is the takeaway that because it's just increasingly there's more and more money? I mean, throw in college athletes who can now use name, image, likeness, which I think is a good thing in different way. But I just feel like the money just keeps growing in collegiate sports, professional sports. Like at some point, not that money ever corrupts, but
Never.
At some point, are we going to potentially see something really bad?
Well, I mean, I'd say probably yes.
Yeah.
I mean, we're already starting to see harassment of athletes, right? Pretty directly for, let's say, costing you on an over-under bet.
Yeah.
But I think you raise college, which is a whole different universe and a whole nother ball of problems for everyone, basically, because the prop bets, which are very, very difficult to police, are even harder to police in college. If you think about it, if you're an athlete in college, you're living with, eating with, going to class with other people, and they could notice, hey, I noticed you have an ankle brace on today. Does that mean you're not playing tonight? Well, if an athlete were to say, yeah, I'm probably not going to, well, that person might say, well, I'm going to bet the under on your points tonight. It's so easy for information to seep out, and they're frankly terrified of it and of this happening.
Well, you raise a question that, at least I'm asking this question, why is it allowed in college athletics?
Well, that's a really good question because there's a lot of money to be made, basically. I mean, there are different states that have different rules around some of this stuff. Like there are certain states where you can't bet on an in-state team.
There's a lot of money to be made unless you're a player.
There is a lot of money to be made unless you're a player. Although, interestingly, when we were talking to the NFL players, they're getting revenue sharing from the deals at the higher end.
Yeah.
But some of them have actually said, hey, if somebody's betting $10 on me to do something, shouldn't I get $1 of that? Shouldn't I be getting a percentage of that? And I wonder if that's not going to come up in a future CBA.
It's unbelievable. Just a lot of money. Where do you want to go next?
Wherever you would like to go.
I want to talk.
wanna go?
I want to talk a little bit about the platforms that are dominant right now. DraftKings and FanDuel over the last few years.
Don't forget ESPN.
Well, they're trying,
Yeah.
and that's the thing, and that's what's so interesting because that's a Disney-owned company, and it's the most magical place on earth.
Right.
And I know it was such a big deal. In the last 18 months or so, when Disney owned ESPN got into this, because it's not necessarily part of Disney's identity. We can talk about that part, but FanDuel and DraftKings were supposed to merge years ago and become the same company. That didn't end up happening. What does the landscape look like for these platforms?
Yeah, so we call it a duopoly in print. You've got FanDuel and DraftKings that run about 75% of this market. Really, they got first mover advantage. I mean, they were huge into fantasy sports, and so they basically had their name made by doing fantasy sports. And then when sports betting became legalized, they started doing sports betting. So they're really like front and center. They're what most people use. It's funny. One of the reasons that most people wind up using them is because they see other people posting wins online. They say, oh, well, where did this guy win? Oh, FanDuel, DraftKings. Okay, well, that's the one that I should be on. They also just tend to offer like the most number of bets. If you're looking for over-unders, like for instance in the Stanley Cup last year. On one particular better night, they, I think, had 8, and some of the other sites had 3. So, if you want to make 8 over/under bets versus 3, they're really going to be the place to do it. They also offer a lot of customization. So they offer customized parlays at a rate that other sites don't. And, essentially they're like, in many ways, the Kleenex of of this industry. They're just sort of the name brand that everybody knows.
Does that mean Disney isn't committed to getting more of this business?
No, they are. I mean, and Disney would argue, like, look, our ESPN partnership with Penn Entertainment is only a year old. Like, let us cook here. Give us a chance. They're at about 2.8% right now. According to them, they're where they expected to be at this point. But it is very hard to gain market share on these larger companies.
Hey, where do you want to go?
Pushback.
Go ahead.
The idea that maybe some might think this is not so good for the industry.
Well, if you're talking about the sports gambling industry, it's great for that.
Right. Not so good for sports.
They're literally all in.
Right. Not so good for sports.
This is more
in society. There are folks out there who say this is not good for society.
And I think they would have a very strong argument that betting can get out of control, and that some of the ways in which you'd want to rein that in are not as funded in a robust manner. But the leagues basically have all made the decision in the last, since Adam Silver's op-ed in the New York Times saying that it should be legalized, essentially to say, okay, we're in. The leagues don't want their product being monetized by someone else and then not getting a cut of that, right? So there's no turning back at this point. That's just not going to happen.
Well, and what's interesting is another story that how it's impacting also sports writing, the media side of it, right? It's just interesting how it's infiltrated. The tentacles have been felt in so many different aspects.
There is a whole ecosystem surrounding this right now. If you turn on ESPN during the day, there's a betting show. Their betting experts are on other shows. The ticker at the bottom of any ESPN show is going to have ESPN bets in it. So it's inescapable.
I always think about like athletes of decades ago or something being like, what? Like,
yeah.
Like we crossed.
I'm not a betting man, Carol.
You are not a betting man.
Let's just say that.
Well done. Incredible. Bret Began, thank you so much. Unbelievable deep dive in the new issue of Bloomberg Businessweek. Bret, of course, is Bloomberg Businessweek's senior editor. Be sure to check it out online on the Bloomberg and also on newsstands.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, our next guest has been at the forefront of the transition from analog to digital, particularly when it comes to music. Here's a little bit of his background. So more than 30 years ago, he was the founder and webmaster, when that was a thing, of BeastieBoys.com. He was then at the company behind Winamp, which was the first way that I think many people who are over the age of 40 now listen to music on their computers.
Yes.
Eventually, he became CEO of Beats Music about a year and a half before it was sold to Apple for $3 billion. After a stint at Apple, he found himself as chief digital officer at LVMH, the $374 billion market cap parent of Louis Vuitton, Dior, Sephora, Hennessy, and more. Now, Ian Rogers is chief experience officer at Ledger. It's based in Paris. They're a digital asset security company. He joins us here in the Bloomberg Interactive Brokers studio. Ian, how are you?
I'm great, thank you. Thank you for that amazing intro.
Well, it's good to see you. I did skip a few years in there, but I did include it because I'm wondering if you see any parallels over your career digitizing music to what you think is happening when it comes to digitizing real world assets.
I think so many. I think that's the right way to think about it. I think the internet was fundamentally a revolution of information. Right, information used to be, okay, how many magazines can you rack at the Hallmark store, and how many channels are there on the FM dial, and how many channels on television? And that expanded over time. We got satellite and we got VHS, et cetera. But the internet was just like, anyone could register a domain and start, yahoo.com, and who knows what happens when you do. And I think what we have now is a revolution of value. And I think that will have an impact that's at least as big on humanity as the internet has had. Obviously value is important in our lives, and I think it will be that far-reaching as well. It's, used to, I remember in the 90s, there was sort of like, this is going to change everything, or this is going to change nothing. It really depended on which side of the fence you were on. And in the end, it touched everything, right? And many of the business ideas which were laughed at in 1999, are things like Instacart today, right? Because in 1999, we had all of the ideas.
Right. Webvan didn't work in 99, but Instacart worked today.
It works today. And,
yeah.
And I think there's also one of the things I learned from that is it sort of takes 15 years for these things to germinate, right? I remember, playing with trying to get content in my living room, in the late 90s. Because I'm a geek and I, chipped an Xbox and was trying to download movies off the internet and watch them in my living room. Fast forward to 15 years later when my mom calls me and says, oh, I canceled cable and I only have Roku. Yeah. And that's just how long it takes from the idea to it really reaching mainstream. So to me, that's the lesson. And I think similarly, many of these ideas that were like, this is going to change everything in 2021 in kind of this Web3 boom, I think if we fast forward to 2036, they'll be right there. They'll be more mainstream.
Before we talk a little bit more about 2036, so is it not only the ideas catching on, but the technology catching up to make
Absolutely.
It really easy to do?
And the user experience, right? I mean, today you can say, hey Siri, play the Beatles.
Right.
And, Paul McCartney and John Lennon come out of your phone, right? But I remember in the 90s, it was, when I started at Winamp, I started there because I was recording sound files from the soundboard at Beastie Boys concerts and then uploading them as this new thing called MP3s, but you had to be really specific. You had to start with, okay, you have to buy a sound card for your computer, and then you download this program called Winamp, and it was incredibly hard to use. I remember the days personally when you didn't say go to my website, you said, there's this thing called the internet, and if you get a computer and a modem and an ISP and a web browser, you can download an ugly page very slowly, right? And so I can understand why people would say, who wants that, right? So there's a long walk though from there to what we have in our pockets today. And I think that's the same thing in this revolution of value that people have a hard time seeing. Look, I paid to come over here on the metro or on the subway, you call it here in New York, with my credit card, right? That's a very inefficient tool for micropayments. Credit cards were not meant for micropayments. I don't actually need credit. What I need is digital cash settlement that's very cheap.
Right.
That's not what the Visa network provides.
Okay, so enter what you're working on at Ledger right now, because I think a lot of people who have heard of it, and correct me if I'm wrong, but 6 million of these devices are actually out there.
Now,
7 million now out there in the wild. I think a lot of people think about it as a wallet for your cryptocurrency. But a lot of people not many people actually use cryptocurrency to transact. They see it as a store of value. But you see it as something much bigger than just storing your digital money.
Yeah, what Ledger fundamentally is a way to protect your secrets, right? So we know that our phones and our computers are very bad at protecting secrets. It's not what they were designed for. They were designed for performance, and they're good at playing games and many, many, many other things. But security is not what they're best at. And so Ledger is fundamentally, we use a technology called chip and pin, which you have multiple of in your pocket.
Yeah.
So your credit card and your passport both use chip and pin technology to protect the secrets of the bank from you or the secrets of the government from you. Ledger fundamentally uses that same technology to protect your secrets. So we have new devices, one of which was designed by Tony Fadell, Ledger Stacks, another one quite easy to use called Ledger Flex, to your point about things getting easier to use. We have a recovery service for those secrets called Ledger Recover. These are all meant to bring this protection mainstream and put it in the hands of more people. And not only can it protect your cryptocurrency and your transactions, but it can also protect your passwords, two-factor authentication, passkeys, Passwords is a problem for every internet user, right? So 5 billion internet users have a problem with security and a problem with passwords. And Ledger is an incredible tool now to protect your secrets. So that could be your digital value, it could be your digital property,
right,
or it could just be your digital life, digital secrets.
I almost feel like it's a thing we've always wanted for healthcare, right? To just put it all there. Ian,
Absolutely.
We've actually been pulling it up for those who are watching on our streaming service and on YouTube. And I think it'll show the device. So this is the device, right?
Correct. So this is Ledger Stacks. which was designed by Tony Fadell. Tony being the inventor of the iPod and the co-inventor of the iPhone. And what Tony wanted to create with this product was something that really, communicated value. So it's the size of a credit card.
Right.
It's got sort of like two metal credit cards stacked on top of one another. But also, here, there's Tony. His question was, what does a future stack of cash look like? You know, that stack of cash with the band around it. So he used a new technology it's this e-ink technology. It's actually a plastic screen. So where a Kindle screen is silicon on glass, this is an organic substrate on plastic, and then you get this 180-degree bend. So the screen actually goes all the way around the spine of the device. Cool. And then they're magnetic, like magnetiles. I don't know if your
kids have many magnetiles at home.
They're so much fun, right? And so the stacks are that sort of satisfying in that same way, like playing with a stack of poker chips is satisfying.
Yeah.
But they magnet together like magnetiles, and then you get that stack of cash look with the curved screen on the spine all the way down. So it really is a luxury device for security.
So give us an idea. So Tim and I would put Tim might put on his, or what I would put. What would we put on there?
So what you would do, generally speaking, I'll give you how an average ledger user or a sophisticated ledger user might use their devices. So they probably have a couple of them. You know, one is for maybe longer term storage, and one of them is one they use every day, and they're maybe a little more promiscuous with. In other words, if you're doing a lot of activities online every day, you want to have, your kind of like big bulk of value in one that you touch less often and you never connect to the web, and you have what I would call a mint wallet, which you're using to interact with the internet of value more often. Maybe it's one that you have even when you're walking around and you want to use it to spend a little bit of money or something. And then the other thing that you're doing, and this might be on that same one, or it could be on a third, is one that you're using for your passwords and your logins, right? So for me, whether it's my my login.gov account, my Google account, my X account, my two-factor authentication is not my mobile number, which we all know is not secure because it's susceptible to things like SIM swaps.
Right.
But it is my ledger, which is using a secure element chip inside of this offline device.
Don't you need to get buy-in from all those third-party services that use two-factor authentication right now in order to authenticate using a ledger?
It's a great question, and the answer is no, because it's a standard, right? So that is all standard 2FA. There are other, whether it's often now that's connected with your Face ID on Apple, or with your thumbprint maybe on your Samsung phone, or your 1Password software might be using that same protocol for 2FA and passkeys. Ledger uses the exact same standard to do that, which is 2FA and passkeys, which is based on the standard called FIDO2.
Does this replace a password manager?
Not necessarily, but it does some of the same functionality. So your password manager helps you manage piles of passwords. So look at the way the average user is using passwords right now. There's only two approaches: either very bad password hygiene,
which means you're using the same password for everything,
which is probably the majority of people, right?
Yeah.
Or there are more sophisticated users that have sort of centralized that risk in the password manager.
But it's still a mess.
It's still difficult. Like, look, the amount of times that even if you have good practice, meaning you're using a product like 1Password, the amount of times that you're going into that thing to get those passwords is kind of astounding. And it shows you, it's funny, I can't remember who said it, but like we just kind of we accept like the way things are broken. Passwords is something that everyone agrees with. We're all operating in a very like broken universe. There are only two options: either really sort of the nightmare of good password management, or bad password hygiene. Joanna Stern from the Wall Street Journal did some great reporting end of last year about about iPhones getting stolen and iCloud accounts getting stolen.
I think Apple actually made some changes that were prompted by that series of stories.
Exactly. And passkeys is a move away from that, right? Yeah. So and that's why Google and Apple are both embracing passkeys and going to having Face ID. It's much more secure to do that with Ledger.
Just got about 40 or 45 seconds left here. So what does it take to get like a complete buy-in from like broader mass society to make this ultimately, I'm assuming you want to build it and have it grow?
So I think usability is a big one. Okay. And I think with Ledger Stacks and Ledger Flex and Ledger Recover, we're heading toward a product where more users can do self-custody, right? And that means self-custody of digital assets. So I think what this takes is broader adoption of digital assets, which comes in phases, and it's coming again. We have another phase coming, I think, right now, and then having more and more uses of these digital assets in our lives, right? So not just speculation, but uses of digital assets in our lives.
Ian Rogers visiting us from Paris here in New York City, Chief Experience Officer at Ledger, here in our Bloomberg Interactive Brokers studio.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, just got about 19 minutes left in today's trading session, and we are seeing the S&P 500 just up a hair. You just heard Amy breaking down some of the trade, which I think puts the S&P. Shouldn't I know this? Because we did see what the S&P closed.
You were on vacation. You don't need to know this.
But I do follow. But we continue to hover around.
This
record
is her
levels.
real-time charting with Carol Massar. It's a new program on
If
Bloomberg.
only I could be like Abigail Doolittle. So just watching the trade here, and we'll see where we end up. But I mean, I do feel like we're just at this, again, a waiting point because we want to get through NVIDIA earnings.
We do want to get through it and kind of like figure out what the next catalyst is going to be, right?
Well, I think it's going to be a few economic data points, right? Inflation, jobs report, and then you get the Fed decision come September.
Okay, well, let's think about what Emily Roland has to say, Co-Chief Investment Strategist for John Hancock Investment Management, joining us from Boston. What is interesting to you right now, Emily?
Well, of course, tomorrow we're going to get the earnings report that's heard around the world. And I think that's what markets are more focused on right now. We've seen tech take a little bit of a breather here. And I think the key thing that investors are watching is, if NVIDIA does disappoint, could there be a broader rotation into other parts of the market? When an entire stock is the size of an asset class, and remember, this stock is bigger than the bottom three sectors in the S&P 500, there's a lot of money that's potentially in motion there that could benefit other parts of the market. So I think that's really the key. Of course, we've got more economic data on the docket as well, but I think it's really that earnings report tomorrow that investors are worried about. And then we could just move on and go straight into that long Labor Day weekend.
Yeah, it is kind of interesting, right? We kind of just go from these like points to points or metrics to metrics, catalyst to catalyst. So what do you do for investors? What do you tell them when they call you up and they say, hey, Emily, what should we be doing right now in today's environment? We talked earlier as a preface or backdrop with our Gina Martin Adams about like looking at bonds and stocks in terms of returns and valuations. And, there are opportunities on both sides.
There are, and one of the nice things right now is that bonds are working as diversifiers. We're actually seeing the correlations between stocks and bonds move lower, and that's been one of the biggest challenges for investors over the last couple of years. Is we've had sort of enemy number one, which is inflation, wreaking havoc on fixed income investors, not being great for equity markets during times where rates have backed up. Now we're in this environment where bonds are working again and stocks are behaving nicely here as well. So that's a really big benefit for investors. We do think that the bond market sort of has it right here. We see an environment where inflation is decelerating, growth is slowing. So we want to be kind of mindful of positioning for this late cycle environment by owning high quality stocks. These are companies that have great balance sheets. They have tons of cash, great return on equity. Right now, margins are getting compressed. You're seeing this amazing earnings and revenue growth that we saw over the last few years as companies pass higher prices along to consumers. That's starting to slow at the same time as the cost of capital still remains elevated. So that's putting a ton of pressure on margins. We want to own the types of companies that can defend margins better. If you look at quality as a factor, it is going to bring you into mega cap tech companies. That's great, but we also have a bit of a valuation issue there. There is some frothiness in the space. So we want to diversify away from that by also owning quality at a reasonable price. I think we came up with that term. I'm still trying to figure it out, but you get the idea. We want to look to the value side. for areas that are trading on sale. Sectors like healthcare are trading at a 10% discount to the broad market. It's got great earnings revisions. And then finally, we want to start legging into some more defensive areas of the market here. We are seeing signs that the consumer is shifting their behavior. We think that consumers might not necessarily buy the next thing they want to buy. Should tell my kids that's happening because, credit card interest rates are 20% right now. We're dealing with some challenges. We saw in the consumer confidence report today that people are less positive about the jobs market. Jobs plentiful is going down in terms of those views. So we want to look at things that the consumer is still going to need to do. You're still going to turn the lights on, take a shower, you're going to go to the doctor. So I think looking at more defensive areas like utilities makes sense. And then finally, to your point, letting bonds do some more heavy lifting in portfolios, given the yields are so elevated there.
So where don't you want to be?
I know, we love it all, right? So one of the things that we've seen is actually this shift into more cyclical areas. That's something that we're actually looking to fade here. So what you've seen is that because of this concept that the Fed's going to be cutting so aggressively, especially versus other central banks, the dollar's weakened. And in a weaker dollar environment, that helps support things like international equities. It's almost like a global liquidity release valve that helps riskier areas outperform. We've seen this bid until really today for small cap equities, that being, again, a function of investors' perception that with the Fed kind of cementing those rate cuts at Jackson Hole last week, that's going to bring the cost of capital down, which would benefit the most indebted companies, which you're going to find in small cap equities. We actually don't see that. We see slowing inflation coming hand in hand with slowing growth, which isn't the greatest thing for more cyclical companies or ones that are more exposed to the economic cycle. So we would be fading this move into areas like international stocks. Not that we don't own them, it's just not our favorite part of the market because of our preference for quality. We'd be fading this move into growth at any price type companies. And again, loading up on higher quality and potentially more defensive parts of the market. In an environment where growth essentially does slow, we do see an economic contraction. You want to be positioned for that.
Is there anything out there that's concerning you about a potential economic contraction just in the last 45 seconds we have with you?
It's tough to see it right now. And, certainly markets are still sunning themselves on soft landing island, but things don't usually end that way. Typically, you see the Fed going too far, too fast. You start to see those cracks in the consumer. And sometimes you don't know it until it's too late. We look at things like initial jobless claims as being one of those most timely indicators. No issues there. But if we saw that break out above, say, 300,000, that would be a concern. It would probably go hand in hand with high yield bond spreads widening out. Those are the types of things we're watching. Again, not seeing it right now, but the music can stop pretty fast here. And we want to be mindful of that as we head into a trickier stretch for the markets.
Emily Roland, Co-Chief Investment Strategist, for John Hancock Investment Management, joining us from Boston.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.